Now, when I talk about where will him and her stock be by 2030 in this video, I'm going to talk more specifically about where the company's revenue and profitability will be by 2030. And of course, to look at that, I'm going to look at management's forecast for their revenue and profitability in those years. And then I'm going to look at the company's historic revenue growth to see what they've delivered so far, to understand and to give a probability of the expectations, right? Whenever a management team gives me a forecast of where they will be, let's say 3 years from now, 5 years from now, or 10 years from now, I like to look at their history. What have they delivered so far? How good have they been on delivering the forecast they've delivered in prior years? And I'll talk about that in this video so that we can understand what the likelihood is of the company hitting these targets they set out for 2030. So Hims and Hers has delivered phenomenal growth over recent years. The company generated just over 100 million in revenue in 2019, and that soared up to 1.8 billion in the most recent trailing 12-month period. So you've had a great increase in revenue for these company in these years. Now, can they deliver that kind of growth in the future? Let's learn more about their prospects by listening to what management said in their most recent earnings call transcript with Wall Street analysts. So the company's management team said that their expectation is that operational efficiency gains and growth from more tenured specialties can offset potential headwinds from macroeconomic factors like tariffs. So inside the company, they're going to get better at what they do, and those improvements are going to help the company improve despite headwinds like tariffs. Tariffs are likely to cause the company to have to pay a higher cost to import some of their products from outside the United States. And of course, if they have to pay higher prices, then they have to make a decision. Do they pass along those higher prices to customers, which will slow down revenue growth? Because if you remember from your beginner economics class, price goes up, demand goes down, right? It's an inverse relationship. So if the company chooses to raise prices on their customers, then that's going to slow down demand. If they choose, they can absorb the higher cost from tariffs without raising prices on customers, and thereby that will hurt their profitability. So they have a choice which strategy to take. Click the link below to watch the full video.